Okay, good morning everyone. We'll start our lesson two. Today lesson will go through LO2 learning outcome 2, which is about be able to prepare budget for organization, and we'll discuss the causes of the cost and the sale variance. My name is Anjum Sacha and my email address anjum@ukversity.co.uk. If you have any question, please if you listen to this recording, drop me an email. Okay, we'll start. We'll talk, how much we know about budgeting and variance. Have you prepared the budget? You dealing with the management account, especially?
We do sometimes.
Sometimes. Okay. So budget, of course, we make and we find the difference between budgeted figure and the actual figure and some variance. Variance can be favorable and variance can be adverse. So we can look around the reason for the variance. Yes. So maybe the variance is favorable at the moment, but it has the long-term impact. So we need to be think about if we are saving money, maybe we are buying low quality material and our variance is favorable, but in future that leads to the customer satisfaction, and the customer satisfaction will be lower. In sales can be, yes, sale variance can be adverse. So this is quite linked with each other. Okay. So today lesson is key indicated content. What we're supposed to learn is budgeting process, function, administration of budget, sales, production. We can make the various types of budget. Zero-based budgeting and different methods we can use.
Sorry, Mr. Andrew, I can't hear you properly.
You can't hear me.
No.
I think so.
Yes, now is it there?
Is it better now?
Yeah.
Okay. Is it better now?
Yeah.
Okay. So that's these, all these things which will go through to the lesson. Okay, first we are looking at sensitivity analysis and flexible budget. Sensitivity analysis method is used to incorporate uncertainty. Uncertainty. Think about COVID-19 and uncertainty. How we can make effective decisions. So uncertainty can be one of reasons. That's why our budget is not appropriate in our area. Decision making is selecting the best course of action. So we have various alternatives and we can find the best alternative. Only we can find, first we have a data. Data leads to information. Information leads to knowledge. And then we can make the decision. Knowledge based decision. Okay, each uncertainty factor in turn, the calculated change that would be reflected in the factor before the original decision and reverse. So this is the involve firstly what if question. How sensitive that? What variables can be changed? By using the technique, it is possible to establish the estimate variable cost. We all know variable cost, the cost of change with the unit of production, are more critical than other affecting decision. So best estimate for the variable made can be analyzed. Each variable we can analyze and we can look around. For example, estimate selling price can fall by 5% before the original decision to accept or disable. Estimate each variable can be used considered to assess the likelihood being wrong, what is the probability of it, by use and the example of chances of the selling price falling by 5% and the maximum change is expressed with that percentage. I think if someone is bad by knowledge, maybe the mobile is die after. Okay. Actually, we can look around that a budget is configuring to make our buy decision, make our buy means we either make our product within or manufacturing or we can buy from outsider. So if we look It's made by in-house. We have a variable cost 10 and we have a selling price 15. So our contribution can be 5. Yeah? Selling price minus variable cost gives you a contribution. Eh? What about next? If we do variable cost external to external purchase cost 6 and we selling on 14 because here is the price lower. So 8 minus 4, 14 minus 8. Yeah? So there is £6 worth of contribution. So which one is the best according to the contribution? So if we made in-house is a 5, if we go external is a 6. Calculate the sensitive to the external price. Find this and the contribution from outsourcing needs to be falls to 5. The external purchase price only need to increase by 1. Yes? So there is a 17% that's sensitive because the contribution between two is how much difference? Is only 1. The price difference is only 1. 1 divided by 6 of this is a 17%. But it means £1 worth of the price, the purchase price increased by £1. Yes. So contribution can be falls to 5 then. So that's we're looking how many percent that can be. Any questions? If you have, please.
No, it's fine.
Okay, then we're looking the sensitivity analysis. There is no complicated theory to understand. Information is presented to management in the form of facilitates yes, subjective judgment to decide the likelihood of the various possible outcome. It identifies the area where crucial to the success of the project if the project is chosen. Weaknesses of the sensitivity. It assumes that the change to the variable cost can be made independently. Material price will change independently of other variables. So simulation allows to use the change more than one variable. So we can use the simulation like in many software even. It only identify how the variable needs to be changed. It does not look the probability of such change. It provides the information on the basis of which decision can be made, but does not the point of the correct decision indirectly. So that is the problem we have with this. Okay. Then we have this will link even with the next our discussion 2.2 as well. Fix and flex budget. Fix is means stay the same and flex is means change according to actual activity. If your actual activity is more, your budget needs to be more. If actual activity is less, your flex, but your flex budget base will be on the standard, which will go through some examples. Okay. Preparing budget. Always we need to be when we prepare the budget, we can look around the cost behavior, the fixed variable cost and semi-variable. Do you know what is meant by semi-variable? We all know, yes? Semi-variable is the cost which fixed and variable together, or fixed and variable cost is together, that's called semi-variable. Okay. That's it, semi-variable. So we need to think about is it fixed or variable or semi-variable. Semi-variable like example of telephone. Yes. So telephone bill. Okay. So it can be line rental and call charges. So line rental will be fixed and the call charges will be variable. So we call semi-variable. Sorry, I think probably use background. Okay. So it's a semi-variable. Please, you can unmute if you want to. So we that's we can think about is a flexible budget. We based on the actual activity. Always remember. And then preparing flexible budget. We are going to prepare the basis to flex the budget will depend on the types of the activities carried out. Manufacturing organization unit of output, distribution department, and personnel department number of staff. That's all we can look around, and that will help to make the decision. Okay, we look here. Our actual budget, fixed budget was 50,000 units to produce, and the 50,000 unit cost. So 1,500,000 if you divide on 50,000, £30 per sale price was. And now actually when we sold it 37,500 units. So if your fixed budget, you marrying the budgeted activity with the actual, but this is not the right criteria because the fixed means stay the same. But actually your activity dropped, your variance is a difference. If you see here is adverse, but in other cases it's coming favorable, inexpensive. But because our actual activity was lower, how we can compare 50,000 people serving food to 37,500? So that's not a right criteria. You look the standard cost for one person and then compare with the 37,500. So you do 1% times 37,500, and that will be your budgeted figure based on the actual activity. And then you do actual always what I actually incurred. Then you do the difference, variance. Okay, like here, this is the flex budget. So this is based on 37,500. So 1,500,000 divided by 50. So we found £30 is the selling price. £30 times 37,500 up came 11,25,000. So you will see here. Yes. Then we did the cost per unit. So we did the material. How much was the material cost of 50,000, which is given in the question. 375,000 divided by 50,000. So we found per unit cost of material was £7.50. That's our standard. Standard cost for 1 unit £7.50 of material. £7.50 times 37,500 units we actually manufactured and sold. So we can find the 37. So that came cost our 281,250. So that's our material cost. And the same way we'll do the labor and all other. And after this, which that's flex it, because we have the same activity than the actual cost incurred and the flex budgeted cost. Then we look the difference, and the difference was adverse variance. Then we look the material was adverse, labor was adverse, but now production overhead was favorable. Yes. And because if we look, the fixed overhead was 130. So fixed mean it won't change, doesn't matter my activity dropped even. Spare capacity I'm not using. So you will see here, overall we have the variance is adverse. If overall variance is profit or is favorable, then it's good. But this is adverse, so that's not a right decision to go ahead under this 37,500 activity level with the price of £30 each, because our variance is coming adverse. So that's why we need to be sell at least 50 plus. So that was the benchmark. Any question? Okay. Then we have a causes of variance. So material have two types of variance. Two types of variance. Okay. First, we always have a material cost variance. What do you budget? What is actual cost of the material? Then sub-variance can be material price variance. Price variance, because how much you bought it. If maybe you get the low quality material, and material price variance will come favorable. Yes, so it can be favorable. But when it's come to usage, maybe using more material. So usage point of view can be adverse variance. So if let's say this was 20 was favorable, £20, and this was £12 adverse. So what is your overall variance now? Yes, 20 minus 12 is 8 is a favorable variance. So that decision is good because your overall variance, cost variance of the material is £8, you're saving it. No doubt is you're using more material because material usage is adverse. But now you need to think about, because overall your cost variance is favorable, but this can be linked to the customer satisfaction. Yes, look around, because we said earlier in one of lesson, performance always equal to time, cost, and quality. So if you're just looking in the cost point of view, it's fine. But if looking the quality point of view and customer satisfaction, that's not right. Yes. So we'll go through each variant. Then we have a labor. You can get the low rate workers from the agency. You're saving money. You're very happy. You're very pleased. But what with respect to, what is the loyalty of the employees? Yes. So you have to look around the loyalties of the, sorry, I think so I'm wrong stuff. Okay, loyalty of the staff. Huh? So we need to be look around the loyalty of the staff. That can be a problem. Yes. So that's we need to be look around. That can be issue about the loyalty. How we can look, that thing. So if the staff is not trained well, they can waste the material. They can't handle because they don't have a skill. That can be a fact. So one way you're saving, other way you need to look around whatever all effect on the profit. So these are different, all the causes of the variance. Material price variance due to the inflation can be adverse. That reason, yes. Seasonal variation can be, lot of demand can be, COVID-19 can be, Brexit can be, or various other things. Yes, we can look around all the causes of variance. Okay, then next we have 2.2, where we are apply the budgetary techniques. Yes, we can apply these techniques to various types of budget. Okay, so what we can look around here, activity based budget. Activity, as the word indicate, the activity mean if your activity increase, your budget will increase. Like in this example, and always we have a cost driver. You need to be find how, like if you planning well your delivery and you planning which route you can reduce the cost, because you're reducing the number of delivery, and you're saying in a week 3 times we deliver, but don't promise it then you will deliver in 24 hours at the same day. If you delivery on the same day, then your cost will be high as long the number of numbers not increase, because your delivery cost is there, because you're going same route. Cost of inward department total is 10,000. The cost driver of inward activity is number of deliveries. During 20x3, there were 1,000 delivery, 2,000 for the product X. Sorry, 200 was the product X. 2,000 unit product X were produced. So what will be the cost of? So 10,000 for 1,000 deliveries. So it's £10 each delivery. So how much is attribute to? So 10 times how many deliveries we have for the product X? So 200. So 2,000 is cost us for to deliver these products. So 2,000 divided by it. So £1 each unit cost are towards deliver that good. So that's the way we can prepare it and we can make the deliveries. Any question? Okay, that was the delivery. Okay. Then we have using the cost and the sale variance, propose, appropriate improvement plan. Yeah, so what I did, I included book for you, which I'll send you. It's called, budgeting. Okay. And we can look around, we can prepare various types of budget. Like here, preparing budget, we have a chapter 4. Yes. So you will see here, we've been given the zero-based budget. Zero-based mean you start with the zero. everything, like such as a new business, they don't have a previously any figure. So all your estimate will be start from zero. Activity-based budgeting, priority budgeting, you can roll budget. These are all. Then we can use, and we'll go through some. This is next we have prepare budget, which we'll go through, and we can prepare the budgets. Like here, this is standard costing budget. So we can look around what was the standard cost per unit, what is the variable cost, and we can make the full cost budget, and then we can compare with the actual. So we have a lot of example here, which we can, and this is the sale budget. Okay, so we'll sale budget. Okay, always budget start from the sale forecast. If you have a right sale forecast and you have a right information, you can make any budget. So first thing, sale budget. If you sale forecast, you make sale budget based on the sale forecast, then you make the production budget, then you can make the material usage budget, labor budget. So if your economics activity sale is slow down, all other budget will affect. Why? You have a more labor, it's a waste of resource, you have to review it. So that's the reason sale is the key thing. So here we've been given the sale budget. Okay, so we look around the period 1, period 2, period 3, how many units we are expecting to sell. Period 1, yes, what we can look around the forecast revenue, how much revenue we are expecting to generate, or how much turnover we, yes, if we are expecting to increase by, so in period 2, period 3, we've been already given here, period 4, period 5. So the price increase, if the price increase in the period 4, 10% of 40, so 40 times 1.04, which is, sorry, 1.1, which means 10%, 40 times 1.1, so it will be, the price will become 44, and then we can calculate. So our sale forecast or the revenue turnover we are expecting in these periods is up to there. So that give, and when we have actual, we can compare it. Yes. If we don't have it, why we don't have it? We can look around economic factors. So these are the some good examples. Please, it's good to be look around. Huh? Any question?
Yeah, no, not so far.
Thank you. So that's, we can look around and we can make the plan. Either I'll drop the price or not. And some we've been again reason of variance. We all been discussed various, each type. If your labor budget, and we can look around the labor, why? Because the worker shortage, skills not available, workforce. So these are uh, disturb our budget really. Using the cost and the sale variance, propose appropriate improvement plan. Of course, we can pick any example. If we have a variance, so we need to be think about price variance. Price variance is coming in buying things from UK manufacturing. Maybe the price variance is adverse. It's costing here, of course, labor cost is high, and all other legal requirements. So what about if we buying from abroad? Maybe the price variance will be favorable. But you have to, anyone heard about social accounting? Concept of social accounting, please.
No, never.
Okay, so if everything will say, come on, why we manufacture chairs in UK? Why not we buy from China? China can give us maybe £2 per chair even. Yes. So if we move everything to China and buying from China, what will be happen? Employment. Yes. It will be unemployment more in the UK. Yes. Due to unemployment, what will be happen? Per capita income, per person income will drop. Yes. If it drop, disposable income will drop, individuals. Yes. Inflation will be high. As a company, we have a social responsibility, social accounting, like CSR, corporate social responsibility, the local jobs for local people, local material we use, local manufacturing facilities we use as much we can, where we not compromise our sustainability. Yes, sustainability. If we don't earn the profit, we can't sustain as well. Yes, we have to keep in mind social accounting, but we have to keep in mind sustainability. Yes, like call center, maybe we can move abroad to reduce the cost, but the jobs, maybe 10% jobs will affect, but overall jobs we can protect it to reduce the cost. So we can think about. So here we can reason for the variance. Maybe we can planning to control them. Actual outcome measurement error. That's what the variance was. Outdated of standard. Oh, you are saying always, every worker can produce this and this. But we have a machine now. Lot of work is happening through machine. When it's happening through machine, what will be happen? Our worker productivity should be increased per person. Yes, we give them training, but accident and the health issue is still the same. So we can say here, why is our training not effective? Yes, your variance is still there. You budgeted 10% will be. You budgeted uh, you set up the credit control department. You said you should check the credit and you train your staff and they check the credit and they allocate the credit facility to the individual or company. So now still our the percentage of the bad debts went up, not went down. Yes. Then you can look around why. Because this is your training, because you spend the cost actually is increasing. Actual variance is coming more. Why? You have to ask the question and provide the improvement plan in future. Maybe our training not appropriate, or the credit reference agency we are using, they don't have a right data and we analyze on it and we giving credit to. So you have to be think about, yes, and we can add any example here of our choice. Any question?
No.
No, no.
Okay, so these are all some controllable, uncontrollable. Of course, some factor we can't control it. We have to adopt it, but we have to look around, consider. So if we look the past political, economic, social, and technological factors, like we have a base rate. We know base rate, basic interest rate at the
Yes.
moment of 0.01%. So this is quite, we can't control it. Maybe go up to 0.25. Yes, we
Mhm.
can't control it. We have to adjust it. Yes, our operation accordingly. We have to shuffle around the thing to make and stay in the favorable and control manner. Huh? Okay, that's we have some example, and then we have our next 2.1 merit criteria. Assess how the limiting factor. What is meant by limiting? We have a limiting mean labor, can be limiting factor, machine hours, yes, and can be unit of production. These can be limiting factor. Yes, what you do, you always look contribution. One labor hour can generate 50 pounds per suppose, and same labor hours can generate for other product 25 pounds per hour. So what you need to do, you need to be allocate your labor hours, whatever you are available, towards the higher turnover first. The product those give you higher contribution. So that's all about which we'll go through here. So labor, we have limiting material can be our production facilities. We have to use it towards the product which we use. Like some people say, some companies, like especially in Japan, they are moving toward high tech. Yes, high tech is a high return, and workforce is a high skills if we have. So why not? Why we manufacturing chair? Why not? We'll go through machines, robots, and things. Huh? So that's all, we can moving around, shuffling our labor workforce from that city to other labor workforce hours. So rescheduling our productions according to the limiting factors. Like here, we can look around example. We have a production capacity in excess of 10,000 units per month incurred at the overtime premium we've been given being forward production months, spare capacity involved, the inventory holding cost. So we can look around the various scenario. We've been given the production, budgeted production month two, what capacity we have. We have a capacity of 10,000 units. So each month we have a capacity of 10,000 units. But look there in the month one we are producing 7,000. We have a capacity 10,000. So we are wasting the capacity here of 3,000. Yes.
Yeah.
We need to be think about in month 3 we are production 12, but the capacity is 10. So there is a problem about 2,000 units. So what we'll do now? So additional production reduce. So we need to be make sure we can reverse our production plan and we can manufacture more in the 1 month. Yes. So we have closing inventory here. That's one rescheduling your activities, so that if we have a shortage of resources that month, why not we plan it in a way so we never short, we produce a bit more so we have in stock. Any question?
That's fine.
Okay, then as we discussed earlier, buy-in are built in, so that decision we can make it, yes, based on the contribution. So 35 in-house and buy 30, so better to be. You look around which one is give you high. So contribution per unit therefore 5 decrease. However, buying in is a fixed cost were to be decreased by. So fixed cost can be decreased if you produce more. Your fixed cost can be if you give out and you're still holding factory and you're paying the rent, why you paying it? Yes. So that's we always need to be maximizing contribution. Of course, we have to look around how we can use the scarce resources. Like in this case, we can look around. We've been given the demand, maximum demand of J, T and G, two types of product, 10,000, and we've been given the selling price. We've been given the variable cost. So selling price minus variable cost give you contribution. Maximum labor hours is the 40,000 available. So if we produce unit T, so what is the contribution of unit T? So your labor is a variable, material is a variable overhead 21, 20, material is 2, 23 other variable overhead 25. So 25, 31 minus 25. So are you getting me? So variable cost of all is 25 and selling price is 31. 31 minus 25, so 6 is a contribution. And for J, we can look around what is the contribution. So 14, 5 and 2, if you add 19 plus 2 is a 21 is a variable cost. So 28 minus 21, there is a 7 contribution. So higher contribution is a J and T is a lower contribution. But we need to, because what is the limiting risk factor? We have a labor hours. 40,000 labor hours is only available. So how many hours required to make 1 unit? This is a 1 unit card. So 21 divided by 7. How many hours? 3 hours required for this product. And for J, how many hours required? 2 hours. So if we make 10,000 units, we require 30,000 hours. If we'll make 8,000 units, we require 16,000. So 30 plus 16, we require total 46,000 hours to make these to meet these demands. We don't have a 46,000 hours. We have only 40,000 hours. So what we'll do now, you've been given here example. Yes, and 6,000 we are short. And the next slide, we said the contribution is 6 and 7 hours required. So contribution of the product divided by the number of hours. So required to make one. 6 divided by 3, £2 per labor hours we can generate. And for J, with 7 contribution divided by 2, so per labor hour is £3.50. So what we'll use now, so rank 1 is J and rank 2 is a T. So we'll use our resources towards J first. So our first priority is the J. So for J, is 8,000 is the demand times 2. So we can use 16,000 hours towards J, and the contribution is overall contribution is 7. Yes, and that will give us £56,000 worth of contribution. Okay, now if you use 16, how many hours left? 40,000 minus 16,000, 24,000 balance. So that 24,000 divided by 3. So we can make it 8,000 units from these hours instead of 10,000 is the demand. So 8,000 times 6. So we can generate contribution of 48,000. So total we can make money up from the labor the overall 104,000 through these limiting factor. If we use towards all the resources first towards T, we can't generate 104. We can generate less. So that's the way we can use our resources effectively to maximize our return on the limiting factor, and we can use the limiting factor effectively. Any question?
And
That's right.
So next we have a merit criteria, analyze the main elements of the standard cost. We know the standard cost card. We can say what is my standard. We can set the standard. Then we can compare standard, which is being budgeted, again the standard, and we can look around actual costs. So our standard is a material A and B is required 6 kg and 2 kg, and the cost will be this, and total per unit will cost us £12 and £6 of that material, and total material, both type of material, will be £18 worth of the material required to make 1 unit. Labor, yes, some skilled, unskilled, is total labor cost will be 58.50. Then other variable production overhead, indirect cost will be 8, and the fixed cost will be, so total per unit cost will be 108.50. So now whatever we are making, we can time by 10,000 units, 15,000 units, so we can multiply with per unit cost. So monthly rate time resource element required, so that's the standard cost.
Yeah, I'll go down there and get the numbers.
Okay, next is looking the different types of standard we can set. So what one standard can be ideal standard. Ideal standard, there is no scrap is available. It's like, we say 10% can go up or 10% can be lower or more. So there is ideal standard is 100% you need to be matched with the standard. Yes, this can unfavorable motivational impact can be, and maybe the quality, and it's a very ideal situation. There won't be any waste. It should be a waste because in human nature we can, the holding material, or even as much we trend, we can still the duration or the economics activities. Attainable standard is mean in industry what is the average 10% bad debts per score. Yes, so it's attainable whatever we said, keeping in view of the industry average. Current is based on the current environment like COVID-19. Yes, and the price, we can set the standard against the current environment. Basic standard, many years ago we set the standard, very basic standard, the workers give us this, but now we have a competition in the world. Our productivity should be increased. So basic standard can be outdated standard. It needs to be altered. If we don't alter it, it's very difficult to be compete with. So these are different bases, are the standard types. We can set the standard. Huh? Any question?
No,
Okay.
it's fine.
Then we've been given, if you want to make the production budget and all budget, we included some examples of budgeting. And when you make the budget, please always keep in mind, if we have a rejection, if we have a waste, so because the unit, we don't have a short final finished goods. Huh? We've been given here general waste and inefficiencies budget, so we can, when we'll do our merit criteria, we can keep, all these and these factors. And that's for this, if it's a waste and this, we have all here in our this book, which will be available on Moodle as well. So you will see here, these are all the budget with the waste and without waste and the control and limiting factor as well. So that's the way we can address these learning outcome. And if you have a question, please drop me email.
What's the book?
That's
So
all.
what's the book name?
Sorry, any question?
Yeah. What is the book name?
Book name will be available. It's called budgeting, please. Management,
Budgeting.
accounting, and budgeting.
Yeah.
Will be available on Moodle.
Okay.
I'll request to upload. So that is quite good to use for this, particularly this elements, variance and all. Okay, so that's all today from my side. If any question you have, please.
Arthur.
No, it's fine.
Okay, so I'll speak you all next week. Hope so, and have a nice weekend and enjoy the time. Thank you. Bye bye.
Yeah, thank you.
Bye. Bye.